Good morning and welcome to the webinar. This is Roger Royce, the founder of the Royce Law Firm, a business, tax, and corporate law firm with offices in Northern and Southern California. For today's webinar, we have Terry Mech and Brandt Brereton, who are going to discuss two particular leveraged financed transaction alternatives that can provide liquidity to your company without you having to sell control of your company. Here in Silicon Valley, we oftentimes focus on debt financings, equity financings, preferred stock rounds, but there are other alternatives that are particularly appropriate to more mature businesses as well as closely held companies. We're going to have an update today on the state of the very active debt market and how you, a business owner, can access it. Terry's discussion is going to focus on popular leveraged dividend recap technique using senior and mezz lenders. Both their discussions will focus on using lending to fund the purchase and sale of equity through ESOPs to provide tax-free liquidity to the seller while shielding the corporation's earnings from income tax. These techniques are very tax efficient and tax effective. Now, our webinar is being recorded. You'll be able to access and find a copy of this on royceuniversity.com as well as on the Royce Law YouTube channel, and it will be available in the iTunes store as a podcast. Before we start, I just want to let you know that we have a full summer of webinars coming up after this one. On July 17, we've got a presentation on agritech, or AgTech, agricultural technologies. In August, we'll be doing a webinar on big data. In September, one on arbitration and alternative dispute resolution. And on September 6th on HR issues. Our speakers, as I said, are Brandt Brereton and Terry Mech. Brandt is a managing director of Butcher, Joseph & Hayes, which is an investment bank located here in the San Francisco Bay Area. Brandt is primarily responsible for West Coast coverage and advisory. He was previously the managing partner of Brereton Handling Company for 18 years, where he did middle market M&A and corporate finance. Terry Mech is a senior vice president and business development officer for PNC Business Credit. He's been with PNC since 2001, and he opened the Northern California office. Prior to PNC Business Credit, Terry was manager of the U.S. corporate group for Sanwa Bank, which is now Bank of the West, where he did loan origination, asset management, and marketing for upper market corporate and real estate clients. He has more than 25 years of finance and banking experience and is also a lawyer. He has a JD from Creighton as a member of Nebraska Bar. So with that, I am going to turn the presentation over to Brandt.
Thank you, Roger. Maybe just to kind of set the table, actually I'm struggling with my share my screen here. Actually, I don't need the screen shared quite yet. Anyhow, just to set the stage, you're a corporate owner and you've thought about a buyout, maybe even you've gone down the path with a private equity firm or two, but the transaction didn't close. You like the idea of some liquidity, taking advantage of the very liquid debt markets and low interest rates that we're seeing, but maybe you're not ready to give up control of the business yet. So we're going to talk about two different ways, two different transaction forms that you can do just that, achieve liquidity without giving up control. The first thing that I want to say with respect to the leveraged dividend recap that Terry will speak to is that if all you want is cash to build you wealth better and probably faster than doing a dividend recap with Terry, and you don't need an ESOP structure in order to do that. In a minute, Terry will talk about the debt markets and kind of give us an update on those and how to take advantage of them. But before we get there, alternatively, if you're still quite intrigued by the liquidity that these markets can provide today, and maybe you've been thinking about your succession and whether or not your management is up to the task of succession, maybe even kind of secretly in your heart you like the idea of your management buying you out, but you certainly don't want to give the business to them. If those are the kinds of things that strike a chord with you, then I would say you should definitely explore a 1042 transaction, an ESOP transaction. In both cases, both the dividend recap and the partial sale to the ESOP transaction, the company is borrowing money to do that. In the case of the ESOP transaction, which we'll get into later, think of it this way. It's kind of a two-step succession plan, as we'll show. You're able to get liquidity initially and kind of let your, for lack of a better term, let your management test drive the company for a few years. And depending on how you give them goals, give them metrics to sort of test whether or not they're up to the task of succession. And depending on how they do over the course of those years, whether they met the goals or not, you decide after that whether or not you sell the rest of the company to the ESOP in another leverage transaction, or if they really aren't up to that task, then you can sell the company to a strategic buyer or a private equity sponsor. So it's a unique advantage, I would say. And so just sort of with that as a preamble and the table being set, I'll throw it to Terry to kind of give us an update on the debt markets, and then after he throws it back to me, we'll sort of drill down maybe on some of the specifics of the tax impact on these transactions.
Thanks, Brandt. This is Terry Mech with PNC Business Credit. First, I'd like to give you a little bit about PNC. We're a middle market focused lender that typically provides financing based on an asset-based approach, but we also utilize the cash flow of the company to form our financing as well. So we have a hybrid ABL cash flow approach to the marketplace. Transactions that we deal with are typically $10 to $100 million in debt size. Typical borrowers that we deal with are manufacturing companies, distribution companies, lower margin business service models. We also have a software lending product as well. PNC is the 5th largest bank in the country now with about $300 billion in assets. As I said, we transact a lot with middle market buyout groups and with middle market buyers. In the Bay Area, typical private equity groups that we deal with examples would be Swan Pace, Bertram, JH Partners, Riverside, companies in buyout firms like that. So on your screen, I'm going to describe what the debt markets can do for a hypothetical middle market company. I define what middle market as a company with revenues somewhere between 25 million to say 500 million, where the owner would like some debt to take out money for whatever purpose they have. We've assumed a company that has $80 million of revenues and $10 million of EBITDA. Assuming $10 million of EBITDA is the result of growth or a somewhat stable performance, it's realistic to assume that total debt available that could be taken out is somewhere in the $40 to $45 million range, or between 4 to 4.25 times EBITDA. The debt, my debt, in my example here, is assumed to be broken out into mezzanine and senior debt. The senior debt can be structured in a few different ways. It can be structured as a combination of revolver and term debt, and it can be based on the credit capacity can be based on assets, or it can be based exclusively on cash flow, or the profitability of the company, or some combination of the two. So what's an example of an asset-based loan? Well, an asset-based revolver would be an advance against receivables, an advance against inventory. Term debt is typically an advance against machinery and equipment and an advance against real estate. As I said, we're a hybrid lender, so we don't stop at the assets. We look at the profitability of the company to determine whether or not we can structure additional term debt that's based on the cash flow repayment capacity of the borrower. So we both look at the combination of the assets and the cash flow to determine how much debt that we can bring to the table on any given opportunity. Most of the debt in the example that I'm showing here is going to be funded based on a term loan. And it's probably, given the example that I have here, it's probably going to be funded based on the cash flow capacity of the borrower. It's quite possible that this borrower has a lot of real estate and or machinery and equipment in which to derive a term loan, but probably more likely that that the deal would be structured based on the cash flow and profitability characteristics of the borrower. So I'm going to assume that the revolver is approximately $5 to $10 million, is an advance against AR and or inventory, and primarily remains unfunded at loan closing. When a transaction is structured against the assets of the company and has minimal amounts of leverage, then, as you might suspect, the cost of the capital is cheaper. Right now, the debt markets for middle market transactions are extraordinarily aggressive. And for low leveraged opportunities, the revolver is often priced at spreads over LIBOR, which LIBOR, 30-day LIBOR, is typically about 25 to 30 basis points right now. The spreads are only about 2%. They're on the low end of the spectrum. I have some of these terms and conditions outlined here under the revolver. There's typically no LIBOR floor. The market is very aggressive. Pricing is at historically low points right now, and spreads, in terms of the LIBOR cost and in terms of the spreads over LIBOR. And available leverage is at its high points right now. The borrowing base on an asset-based revolver floats up and down with the levels of working capital in the borrower, namely the receivables and the inventory. For small transactions in the lower market, oftentimes an owner is asked to put up their personal guarantee to guarantee the repayment of the debt that's being taken out. And that's typical on a small deal, but not so in the middle market or in the upper market. Like a transaction of this size would not require a guarantee would typically not require a guarantee from the owner of the company. So the revolver we're assuming is primarily $5 to $10 million and is going to be undrawn at close. And so the majority of the debt is going to be in the form of a term loan, the senior term loan. And this summary here has a range of pricing that is typical in the marketplace right now. For lower leverage transactions, if you just want to take out debt at 1 or 2 or maybe even 2.5 times EBITDA, then the pricing was going to be at the low end of these pricing range spectrums. And when you want to take the leverage all the way up to the peak of the range at 3 to 4.5 times, well, then the pricing is going to be near the higher end of the pricing spectrum. On this, we're still talking about the senior debt, the revolver and the senior term debt. The maturity of a credit facility is typically 3 to 5 years. And because there's typically a modest amount of amortization that's required on the term loan, anywhere between as low as 5% of the principal balance, as high as maybe as much as a 3-year straight line amortization, which I have reflected here as 33% annually. Thus, there's oftentimes there's a balloon payment associated with the loan maturity of the term loan, where you've paid down a small amount of the term loan, and then a balloon payment is due, and that's typically refinanced or rolled over with the existing lender. There's typically a net cash flow recapture that's associated with these higher leverage deals, and a net cash flow recapture is typically defined, to put it simply, as EBITDA less the paid capital expenditures, less cash taxes, less all of the principal and interest that's due on all debt in the cap structure of the company. And that free and clear net cash flow is available, and typically a lender will want 25 or 50% of that free and clear cash flow to rapidly deleverage the term loan and apply that as a principal repayment on the term loan. There's typically prepayment penalties associated with senior debt, but not for partial prepayments. So if you're just talking about normal amortization and the net cash flow recapture provisions, that is not subject to a prepayment penalty. But if you have a 3 or a 5-year deal and you want to refinance with a new lender and take out the entire credit facility, well then oftentimes prepayment penalties can apply. And we start out typically at 3-2-1 for a deal that's 3 years in length, and negotiate lower prepayment penalties from that starting point. Covenants typically there's 3 major covenants that are fixed charge coverage, which is basically the company's net cash flow over the total principal and interest, expressed as a fixed charge coverage ratio, a net worth covenant, and a maximum leverage covenant. And typically those covenants are set with 15% leeway to the projections or the actual results of the company, so that they're not set over in an overly tight fashion. So that's the senior financing that's available in the marketplace. The total senior financing is typically somewhere between 2.5 to 3.25 of EBITDA. 2.5 is a very comfortable level of senior leverage now, and 3.25 is very much readily available in the marketplace. I will say that when a company has a private equity backing, that many lenders find that to be an attractive additional feature, and so sometimes slightly higher levels of leverage and slightly more advantageous pricing is available to companies that are middle market equity sponsor backed, as opposed to fully independent owner owned companies. But nevertheless, this type of leverage should be available to either a sponsor-owned company or a non-sponsor-owned company. Mezz debt typically is junior to the senior debt. There's typically a fee probably closer to 2% on mezzanine debt. Mezzanine is typically structured so that it yields somewhere in a mid-teens yield, and that can be in the form of pure interest coupon, or there can be warrants associated with a mezzanine loan. Now, because the market is so competitive these days, warrants of 5 to 10% ownership are not typically available to a lender. And it's much more common, given the competitive nature of the debt markets, to do an all-interest coupon deal on a mezz loan. A typical mezz transaction would be structured at 1.5% to 2% in terms of fees up front, and 12% current pay on the principal amount of the mezzanine loan, maybe with as much as a 4% PIK, which is basically accrued interest that does not have to be paid current, but could be paid current if the borrower has the cash flow capacity to do so. This financing is also typically non-recourse, does not require an owner guarantee. Sometimes the mezzanine debt takes a second lien to the senior lender, and sometimes it's just unsecured. The maturity is always slightly longer than the senior debt, typically another 6 months in addition to the senior debt. Amortization, oftentimes there's no amortization. Typically it can be interest only. However, these deals can be structured with some principal amortization as well. The mezzanine lender negotiates with the senior lender as to who would get the net cash flow recapture. It's not typically in addition to the senior lender. So normally either the senior lender or the mezzanine lender gets the net cash flow recapture. There's prepayment penalties similar to the senior lender, but they're typically a little more onerous with respect to the mezz loan, which wants their loan left in place. And the covenants are oftentimes quite similar to the senior lender, but they generally are set with about 15% leeway to the senior lender's covenants. The bottom line here is that the middle market debt, is flowing right now, and if owners want to take money out of business and leverage up their businesses, it can happen. I've talked about a debt recap of 4 to 4.25 times of EBITDA, but lower leverage recaps are certainly available and probably easier to accomplish at a lower cost of funds and a lower cost of capital. I'd be happy to speak with any of you either in the question and answer period of this seminar or at a later point in time about the specifics of your business. And I'm going to turn this back to Brandt to talk a little bit about the ESOP, leverage ESOPs.
Thank you, Terry. Just working through the technology here to show you the bear with me here. Okay, so this financial fact pattern that you see in front of you is matched up with what Terry showed you. Let's just assume hypothetical situation. You've got a privately held company, 80 million in revenue, 15 million payroll expense, EBITDA 10 million. Let's assume that the company's worth 8 times EBITDA, and because they're 10 million drawn on their current existing debt of line of credit of 15 million, the equity value of the company is 70 million. And let's assume that the shareholders would like to achieve $45 million in liquidity. What let's look at then is what would be the impact, tax impact, without drilling too deeply into tax code, because I'm not a tax expert, but what would be the tax impact for the individual shareholders, and what would be the tax impact on the corporation post-close in either of these two scenarios? And so let's first look at the tax impact on the shareholders themselves. I think it would be unfair to assume or to say that the ESOP is better in all cases for the individual shareholders, because in the leveraged dividend recap, it very well could be that there's a return of principal that is being paid back to the shareholders vis-a-vis the leveraged recap, and that could be a tax-free transaction. But what I can tell you is that in every instance where there's a C corporation that is selling shares to the ESOP, assuming at least 30% of the stock is owned by the ESOP post-close, the cash, the liquidity from the loan that Terry would help arrange, is the capital gains tax can be deferred under Code Section 1042. So capital gains tax can be deferred, and in some cases eliminated altogether if you follow the rules of 1042. Clearly a benefit in virtually every instance that the ESOP is used in a leveraged finance transaction. This slide that you've got in front of you that you can see it sort of looks at what's the tax impact to the corporation as opposed to the individual. So the left column is the leveraged dividend, the right column is an ESOP, and as you might imagine, with significantly more debt on the books, in the left column you'll see that the additional interest expense, which is deductible to the corp, minimizes the tax liability, the taxable income, the tax liability of the corp compared to what it was before the new debt was put on the company to fund the leveraged dividend. In the case of the ESOP transaction, you've got very, very significant flexibility with respect to deductions. Essentially, what you've got is you've $8.5 million of contributions that can be made to the ESOP. And big picture, effectively what you've done is you've created $45 million worth of deductions that the corporation can take, because the ESOP is at once a corporate finance tool and a qualified plan. So the corporation can contribute up to 25% of its payroll expense on an annual basis and make that contribution in pre-tax dollars to the ESOP every year. And if you sort of just stop there and think about that, what that, for companies that have large payroll, large employee bases and large annual payroll figures, 25% of your payroll expense can oftentimes be upwards of 80, 90, maybe even 100% of your taxable income. So the ESOP, the government allows a tax shield effectively on the earnings of the corp vis-a-vis the ESOP, and that, in addition to other flexibility that exists with respect to paying dividends, making distributions to participants, allows one to minimize, or in many instances eliminate, corporate tax at the entity level. So hard to strike a balance between giving everybody a sort of, enough of a picture on the dramatic differences between the tax shields and getting into too much detail. But the point is, very doable, and thousands of these transactions have been done over the course of many, many years. I will, I think, maybe move to this next slide I'm sure there'll be questions and answers, and at the risk of going into too much detail, I think what I'll do is just sort of diagrams as simplistically as possible kind of what's happening in the leveraged ESOP transaction. If you follow the black arrows, basically, you know, a bank like Terry's is going to lend the $45 million to the corp. The corp in turn is going to lend the money to the ESOP, and that is the money that is used to buy the stock, the amount of stock that's being sold to the ESOP. And assuming the shareholders follow the rules of Code Section 1042, they can defer the capital gains tax on those sale proceeds until such time that they either sell the replacement property. You have to roll that cash into U.S. stocks or bonds, public or private. And if you never sell that replacement property, you die, basis steps up, the capital gains tax goes away. If you elect to sell the replacement property while you're alive, then it triggers the cap gains tax all the way back to the original basis. So that's how the money is getting to the shareholders. You know, the lender is very comfortable with the balance sheet and the cash flow of the corporation, as Terry touched on, and because of that credit profile is willing to lend the money to the corp and in turn to the ESOP so that the shareholders get their cash. And effectively what's happening is that stock is now being held by a trust called the Employee Stock Ownership Plan that the employees are the beneficial owners of, and a promissory note is owed back to the CCorp, and obviously there's a loan agreement in place between the corp and the lender on the original loan. And so that's kind of as simplistically as possible. That sort of describes how that transaction works. And I think maybe we can kind of stop there and maybe just field questions, Roger.
Okay, thanks very much. So let's take maybe a step back and follow up with what you were saying about the ESOP structure. What kind of company is a good candidate for an ESOP? And I guess the corollary to that is what kind of candidate would not be a what kind of company would not be a good candidate for an ESOP? I guess I've heard that this structure tends to fit product companies better than service companies, maybe companies that have attained a certain level of EBITDA or asset concentration. Can you give us some general guidelines?
Sure. I would. First of all, there are many service companies that are ESOP owned, so I wouldn't draw the distinction between product and service necessarily. What I would say is that if you sort of step back from this, it's a debt-driven transaction. It's not an equity transaction. If you think about it, it's a leveraged transaction, and so companies that are attractive to lenders are healthy, profitable, relatively stable companies. One way of thinking about it is it's sort of tongue-in-cheek, maybe not the prettiest girl at the party and not the ugliest. So if it's a company that's growing dramatically and their earnings growth is just a rocket, then probably not a great candidate to do the ESOP, because the public markets and the venture markets will be very attracted to that kind of growth. But if there's more muted, stable earnings, that the kind of cash flow that Terry would be attracted to from a lending perspective, safe debt serviceability, if you will, those are the kinds of companies that are very attractive for the ESOP. And another one, maybe to put a finer point on it, any company that a private equity group is interested in investing in buying is a good candidate, a great candidate for the ESOP transaction. Both of those kinds of transactions are debt financed, looked at in very similar ways, and frankly, in almost every case, valued very, very similarly. So if the company is being valued similarly, private equity versus the ESOP, and you layer on top of that tax-free proceeds, it's not hard to imagine that the ESOP is something that should absolutely be looked at when capital gains rates in California are 35% plus.
Okay, thanks, Brandt. Terry, in this area, companies that are strong enough to do these sorts of transactions, the dividend recap or anything using debt, is also looking at equity. And sort of the first question that we always have is what makes the most sense, usually for a company. And again, taking a big step back, what would you say that the parameters are, or the considerations for a company that's deciding whether it should go solicit maybe a debt financing as opposed to trying to raise an equity round from a private equity or venture capital firm? Is there any characteristics that make them a better prospect for one versus the other?
Well, there's some obvious things, but I'll just say generally with respect to the market, right now we've got an extraordinarily aggressive debt market. 4 years ago, a company with this profile would be just borderline to be able to access the cash flow markets, because they were, things were so constrained, and you needed a company with at least $10 million of EBITDA in order to access a cash flow loan. And then maximum leverage was probably about 2.5, maybe about 2 times, 2.25 times, with Mez taking it up to maybe 3 times or 3.25 times. Now, 4 or 5 years later, things have gotten better, and the debt markets are increasingly more and more aggressive. A year from now, it's possible that these leverage characteristics could be higher. It probably will be, given the trends that have been in place for the last couple of years. So I will say that, generally speaking, that debt is very readily available and is priced in a reasonably cheap fashion. So why do I start out with that? Because anytime you look at equity versus debt, obviously debt is not dilutive, and equity is the most expensive capital that exists because you're diluting your precious ownership. You may have other, you may be driven by other characteristics, though. I mean, that's why we have the topic on the table today. The ESOP is effectively selling a portion of your company to your employees, and that may be where your goals are, getting a fair price and compensating your employees for doing a great job helping you build the business. So it's not all just dollars and cents. Equity versus debt, generally speaking, if you're driven solely by the economics, then generally speaking, debt is a better play when it's available than taking equity. But naturally, you don't want to over leverage your business and preclude yourself from pursuing strategic opportunities as they present themselves, or putting your business in jeopardy of being illiquid if things change. So an owner is the best judge for what is a reasonable level of debt. Just because the market says you can get it doesn't mean you necessarily should take it all. I mean, that's a lesson that the residential market learned in this last business cycle.
Okay, thanks. So one of the questions that came in from our audience has to do with the tax aspects, because both of these strategies, I think, leverage some tax-efficient techniques. And, you know, we've been hearing a lot lately about tax reform. In fact, Senate Finance Committee is out soliciting comments, and they're talking about a blank slate idea, meaning that pretty much everything, all tax expenditures are on the table. Do you guys have any insight or any predictions as to whether the tax law might change to make debt less attractive? For example, one of the proposals that I've seen that's out there has been to deny deduction for interest, to put it on sort of the same kind of footing as dividends that a corporation pays, after some highly publicized tax structures where companies had borrowed to pay a dividend. Do you have a sense as to whether the legal or tax environment might change to make either of these strategies less attractive? And maybe we'll start with you, Brandt.
You know, I really don't. I continue to scratch my head about what happens in Washington, D.C. Frankly, I don't. I've heard so many different stories and so many different scenarios of what could be. I honestly don't have a sense.
You know, I'm not really authorized or qualified to offer my opinion on that subject as well. This is Terry at PNC, but I got to believe that the deductions for debt at the corporate level, I don't. It's hard for me to believe that a revision of the tax code would change that, one of those fundamental precepts.
You know, yeah, similarly, you mentioned, Terry, that we're in a really strong market right now for debt. And I think we remember, you know, in years past we've had strong markets, and, you know, we've gotten a whole host of regulations as a result of it. What's your prediction on how long we can plan on market conditions being similar to what they are now, especially given with what the Fed has done recently? Any sense you can give us?
Well, I would just say that banks are being required to have higher equity positions to try and fortify themselves from the type of TARP bailout process that that existed a mere 5 years ago. So banks are busy building their capital base, but the second part of your question was what? Roger?
Yeah, no, I was asking if you, well, two things. Number one, if you foresaw this market is continuing for a while, and that's just to get your crystal ball out. And secondly, if you were aware of any regulatory changes coming down the road that might affect some of these techniques.
Okay, well, that was the comment that addressed the regulatory situation. But with respect to the banks, we tend to run in herds, and so right now the aggressive behavior is being driven by no loan losses, and so as soon as we start to see loan losses, then the debt markets pull back, and the banks have gotten much better at reacting and correcting their marketing and their loan standards based on what's happening in the portfolio, because there's better monitoring information available, and we're able to detect a weakness in the marketplace quickly. So while we're able to react quickly, I don't foresee that there's going to be any dramatic changes in the debt markets, in the availability of the debt markets in the next year or two, because things are going along on the economy in a relatively even keel, perhaps even picking up steam. If you just look at the various economic data on jobs and things that are available in GDP growth, you'll see that there's basically modest positive trends, and unemployment is decreasing, and there's really no reason. The real estate markets, both commercial and residential, are starting to feel more robust, the stock market's reacting accordingly, and so things are sort of heading in positive directions, and there's really no loan losses in our portfolios that anybody's pointing at, and so I guess that's a long answer to saying I don't see any major corrections in the debt market, in the aggressiveness of the debt market in the next year or two, not in the foreseeable future. And then that's what our economists, it's like I read the PNC's economists issue position papers, and that's probably reflective of what our bank's position is as well.
Yeah. Terry, I'm looking at your example here, and one of the things that sort of jumps out at me is I don't see any warrant coverage in this. Isn't warrant coverage pretty typical?
Well, warrants used to be required. When markets are constricted and capital is scarce, then it's all supply and demand driven. And so, to the extent that you're getting a lender of last resort, and you're getting that last piece of capital into a debt structure, then mezz lenders would be happy to accept warrants. And in more riskier situations where, let's say, a technology story where the company has not fully developed its go-to market opportunity and does not established the positive trends and the predictable cash flow associated with the story, well, then perhaps a warrant is very much appropriate in a debt structure. But when you have what I call a middle market transaction, which is what our hypothetical was here, and you have $10 million of profitability and positive trends and some historical performance that shows that that's been done perhaps year over year, then that's a risk profile at this level of leverage that's not going to be able to, the mezz person would be happy to take the warrant, but they're not going to, the competitive marketplace is not going to allow them to get it.
Interesting. So I guess what you're saying is currently in the market, warrants are less common right now.
In the middle market, that's correct. I mean, there are some segments of the market where, venture leasing and, more venture-oriented transactions, or in the lower market, where the profile of the company is much smaller and less developed and defined and predictable. Those kinds of transactions are going to, be warrant type transactions, but not really in the middle market or in the upper market.
Okay.
Roger, this is.
Go ahead.
Sorry, I just was going to comment on your previous. This is Brandt on the previous question about sort of market conditions, and one of the things that I think that we kind of forget, all intuitively know but forget, is that we're in the throes of the baby boomer retirement wave, where millions of Americans are entering retirement age, and sort of notwithstanding the cost of money, the cost of debt financing over the next several years, the demand for it, because of all of the baby boomer business owners that need to exit their business and diversify their wealth and retire, be it private equity buyers, be it public companies, or for that matter ESOP, the demand for debt, which is the lifeblood of deals in whatever form they take, is going nowhere but up, just demographically driven. So I would tend to agree with Terry that we certainly see the next couple of years as being very, very strong in terms of the debt markets.
Okay, thanks, Brad. Getting back to your ESOP structure, I've been putting these in place for 30 years now, and what I really love about it as a tax lawyer is just how efficient it is. How basically you're getting the government to help finance the company buying out a majority shareholder. And it seems particularly useful in the case of an S corporation. And I wonder, Brandt, are you seeing these structures used quite a bit in conjunction with S corporations, and are there some particular advantages there that you can address?
Oh boy, there are. The first thing I should say is that the only way that a seller can get access to 1042, i.e. the only way that they can defer or eliminate their capital gains tax on the sale proceeds by virtue of selling to the ESOP is if the corp is a C-corp. So what we are seeing and have seen is that, you know, typically healthy companies are operated as S-corps, and so if they're serious about pursuing the ESOP trade, then it's converted to a C-corp right before the ESOP transaction to allow for the 1042 benefit to flow to the sellers. And the company operates as a C-corp as it amortizes down the loan, pays it off. There's a 5-year waiting period before a C-corp can go back to S. And in many instances, we're seeing clients that will convert after 5 years. Depending on how much of the stock they sold in the original transaction, they'll convert back to S because thanks for the big softball cream puff pitch here on this one, Roger. The S corp, as everybody knows, is not a tax-paying entity because it's a flow-through entity, and so the individual shareholders of the S corp pay taxes. To the amount of stock that is owned by the ESOP in an S corp structure, that percentage of ownership is the percentage of the ownership of profits that no tax is paid on. So in an extreme example of this, if you've got a 100% ESOP owned S corp, the S corp has one shareholder and it's the ESOP, that entity pays no taxes. I'll say it again. If the S corp is owned 100% by the ESOP, it has one shareholder. That one shareholder is a non-taxable entity. Then the entity no longer pays corporate income tax. Similarly, if the S corp was owned 70% by an ESOP and 30% by its original shareholder base, then 70% of the profits no tax is paid on, and 30% flows through to the shareholders. So that law has been in place for many, many years, and many companies have taken advantage of it. You know, with everything that's going on, back to your Washington, D.C. question, personally, I don't know if that will continue over the next decade, but today it exists, and many, many very astute business owners are taking advantage of it legally.
Yeah, it's surprising that more companies do take advantage of these strategies. So we're getting towards the end of the hour here. I just want to give you folks an opportunity to, if there's anything that we haven't addressed or any questions that we should have asked, to go ahead and sum up. I want to remind folks that our webinar is being recorded. It will be available on royceuniversity.com, the Royce Law YouTube site, and in iTunes as a podcast. So it will be available for viewing probably in a couple of days. So Terry, Brent, any closing words for us?
I do, but Terry, feel free to go ahead if you'd like.
Sure. I guess you could probably tell from the nature of my remarks that the debt markets are very aggressive right now, and so to the extent that you want to take a few chips off the table, now's a really good time to do so. You don't have to do it to the absolute tip-top maximum leverage. If you do something, you know, in a moderate way, just maybe 1 or 2 times EBITDA, you'll be able to be able to take a few chips off the table and do it probably in a very cost-effective fashion.
Good,
I think the one takeaway that I would want listeners and attendees to kind of go away with is that capital gains rates for the last 20 years pretty low, and the alternative liquidity alternatives that have been out there have been great, and you just paid your small capital gains tax, and that was part of the cost of the transaction, and you moved on. And when fiscal cliff played out this last December, capital gains rates went up very substantially, north of 50% in California. And so today we stand at a place where, the typical business owner, when he's looking at liquidity, especially if it's an M&A trade or a private equity trade, you're going to pay 36% capital gains rates. And for the last 20 years, we really haven't had to pay too much of attention to this little thing called 1042 or this ESOP transaction. And now the tax cost is so great, and the millions of dollars that are at play that either stay in your pocket or go to the government are so substantial that it warrants a study and at least a feasibility look before you leap, if you will. So implicit in that is that, of course, we would love to help people look at what can be done in a feasibility study. And I thank you, Roger, for allowing us to come on and speak.
All right, I would like to thank you as well, Brandt and Terry. And one last thing, so how do folks get a hold of you if they want more information?
Probably the best way is just to give me a buzz. Telephone numbers 415-733-1524. 415-733-1524. Be happy to walk through any of the possibilities.
Same with me. Cell phone's best, actually, so that wherever I am in the West Coast, I'll answer your call. 408 area code 877-6329. Again, it's 408-877-6329.
Okay, thank you again, and with that, we will conclude the webinar.